Hey, Kyle.
Yep.
You just got back from Paris, right?
Yes, I did.
There was a conference, or what was going on there?
So the ETHCC was the big event. ETH Global, which is the hackathon, was on the weekend. There was a modular summit, which was like on modular blockchains on Saturday morning. A whole bunch of side events. We were running breakfast, crypto breakfast on Friday morning. And yeah, a lot of just side meetings. Drop by one of our data vendors, a potential BD partner as well on Friday afternoon. So yeah, very intense 4 days, but it was great.
What would you say like the overall vibe was? It sounds like to me this is a lot of these, people that are trying to build on blockchains and develop things like that. What was the vibe there?
So it was definitely more of a technically angled conference and group. So fewer asset managers. There were like some VCs around. So I would say it was broadly optimistic. The here in New York, like not long before I left, sort of the Ripple ruling dropped. So I was in some pretty happy rooms,
Yeah.
in terms of like optimistic about the industry. But there was a good bit of buzz around it, and the one thing I was hearing from people was they were, I think it's pretty common at a lot of these conferences. They were the conference itself was definitely not as much the centerpiece. It
Right.
was all the side events, it was all the networking, and so I think it was great getting everybody together. And I mean, I was reflecting on this, something I posted, I think the day that I left Paris. So a decade ago, I read the Nakamoto white paper. And so I read another white paper from one of the modular blockchains on Sunday afternoon, while I was kind of waiting to head to the airport. And it just struck me like how much has been built and how much the just core infrastructure has advanced in that decade. And that was just really exciting to see. And like seeing people still innovating, finding ways to decentralize various scaling components, finding ways to introduce privacy, filling in a lot of the gaps on the infrastructure from, that white paper 10 years ago. So it's great to see that investment still happening. I'm further from the tech side of things nowadays, and more on the finance side of things. But like, it's an essential piece of it to actually get everyone on board.
Hey guys, thank you very much for joining us for another episode of CFB Talks Digital Assets. We are the home of informed conversation about crypto for institutions building the future of finance. I'm Ken O'Deleger, and I'm joined by my colleague over there in New York, Gabe Selby. Today, the main topic is risk. Now, that's pretty broad, but we're thinking about risk in cryptocurrencies, a very, very pertinent topic for that asset class. Now, we are more interested in risk in terms of the management sense. So we're looking towards risk management models and value at risk and stuff like that. To that end, we are joined by our esteemed guest, Mr. Kyle Downey, who is the founder or co-founder and CEO of a firm called Cloudwall. Now, just a little bit of a thumbnail history of Kyle. Kyle spent around about 17 years at Morgan Stanley, where through various roles, he was facing the prospect and tasks around about risk management, particularly as it pertains to trading. So models and applications of various sorts to enable the optimum risk within the executable framework for assets that Morgan Stanley traders were participating with. So we are going to talk about Cloudwall. We're going to talk about risk. And we're going to talk about everything else that Kyle is involved in right now. So Kyle, we are so stoked to have you. Welcome aboard.
Thank you so much for having me on the podcast. So yes, so I've spent over 20 years in kind of Wall Street IT, most of it at Morgan Stanley, and a big chunk of it was at leading a department called Automated Risk Trading, which kind of intersection of trading tech and quant for a lot of those in-house systems. But a decade ago, kind of came across Bitcoin as many of us did, down the rabbit hole. So in the fall of 2021, after many years left, and kind of looking around at the space, one of the things that was really remarkable in the fall of 2021 is a lot of the firms that, in traditional finance were building risk systems, your Barras, your risk metrics, your Moody's Analytics, all of these companies did not exist at all in crypto. And risk is fundamental to finance. Like, it would be as remarkable as custody being missing or trading being missing. So even though I'd spent many years in electronic trading technology and really more on the algo execution side than the risk side, that was the thing that we really leaned into and said, look, this is the thing that needs investment right now for the industry. And kind of out of that history over many years at MS, I had crossed paths with Jiaying Wei in Singapore, who's our COO and co-founder for Cloudwall, as well as our CTO, Marcus Sabelis, who I originally hired in Shanghai when I was working out in Asia. So it's definitely like a connection to that former life that was carried forward into Cloudwall as well.
Yeah, so let's talk about Cloudwall, shall we? I believe that your principal application or product is called Serenity. Is that correct?
That's correct. The Serenity Portfolio Risk System. It's a PMS with an embedded set of risk models across spot and derivatives, and a whole suite of tools that do stress testing, VAR analysis. You can do risk attribution. We built the world's first commercial grade factor risk model for cryptocurrencies. So you can do analysis of your crypto portfolios wherever they come from, whether they came from a wallet or from an exchange or from an institutional custodian. We can kind of merge them all together and run that sophisticated analysis using tools much like the ones that were available to those equities and equity derivatives traders that I used to work with at Morgan Stanley, but calibrated and fine-tuned for the specific needs of digital assets.
Hey, Kyle, real quick, before we go too much further into, the product suite and the specifics of it, would you be able to define your framework for how you define risk or how you look at risk?
Yeah, so Ken kind of alluded to this. Like, the problem with saying that you do risk is that everyone walks away with like, oh, it's this type of risk that I normally think about, and there's like 20. Even like limiting it to finance. So
Right.
we think about it really in four quadrants as like high level relevant financial risks for portfolio managers. So market risk, liquidity risk, operational risk, and credit risk. So in the initial versions of our product, the focus has been market risk, but the view is that those four types of risks are the ones that a portfolio manager making decisions about the allocation in their portfolio, what they select. These are the things that they're thinking about. These are the things that they want to monitor. And of course, the fascinating thing about digital assets is that all of these risks, and many of the models actually that we're kind of using as starting points, they have analogs in traditional finance. Like, we're not starting from zero on these things, but the particulars and the way that they're weighted is very different in crypto. So, taking a concrete example, a crypto trader on any given day thinks far more about liquidity risk and operational risk than your average equities trader does. There's no analog to smart contract risk or infrastructure risk. Solana is down today again, or anything like that. Operational risk, which was something I did pretty early in my career, was like almost just this little corner of financial risk that, like, oh yeah, we should also worry about that. But it's really dominant in crypto, which I think is one of the things that's fascinating about sort of how to think about risk in this space. That it's kind of the same themes, but different emphasis across those themes.
Yeah, I think that's a really good way to kind of, break things up and segment it as far as the different categories and stuff like that. So, since this podcast is going to talk a lot about risk, I thought it'd be useful just to kind of gain some perspective for our listeners and viewers and provide some context on some just high level statistics here. So, over the past 5 years, digital assets have averaged about triple the volatility of stocks and commodities. I pulled the 90-day annualized volatilities and I used our CF Broadcap Index floating weight, which is kind of the most institutionalized, broadest exposure of digital assets that you can kind of find in the markets right now. And that clocked in on average for the past 5 years on a 90 day annualized volatility at approximately like 70%. This compares to about 19.5% for the S&P, 15% for the MSCI ACWI, and also the Bloomberg Commodity Index. And if you're wondering, just in case, you have global bonds, which were, just around under 5. So the point here is just, this is kind of like, we've seen these assets kind of trend lower over recent time. You see, as they get more developed, the volatilities have kind of compressed and converged more with U.S. equities, but there's still, a lot of volatility here. And I think, practitioners, portfolio managers need tools to kind of really understand, what they're dealing with. And so they can, really measure their exposure, not lose track, take excess risk. So just some little extra stuff to throw in there to provide some color.
I would just add, risk. There's always a dual nature to that, right? Because those portfolio managers, they're also making choices about the risks that they want to be exposed to, because they see opportunity in actually capturing that risk. They have a view on it, as opposed to ones that they want to hedge and avoid. And a number of people who I used to work with on the desk, particularly on the equity derivative side, looked at those numbers and said, "Well, it's like the market I know, but more." Like, it's sort of amplified, and saw some great opportunities, not just in arbitrage, but just in the extremes. That those extremes are quite hard to model. But particularly around volatility, this something is very well studied. And so you can certainly pull a lot of those lessons on those extremes and say, look, if I have a better handle on this than everybody else, I can trade more effectively around that very high volatility and get exceptional returns.
Yeah, I think now is a really good time to maybe talk, into more detail about, the products and services that Cloudwall offers. You can go into Serenity a little bit more, just kind of expand a little bit more on those features and functionalities on how, a practitioner would use it.
Yep. So I'll start with what it does today, but I'll at the end touch a little bit on the direction that we're going, because the space is quite diverse, and an initial startup's product is never going to cover that full range. So today we cover CFI products, listed on exchanges, spot and derivatives. We cover 130 different tokens, and then futures, perpetuals, and Bitcoin and Ethereum options, all on kind of like the major institutional exchanges. We connect portfolios from many different sources, so we can provide a merged view, say, of your hot wallet and your cold wallet, so everything you hold. One of the key things about risk and portfolio management systems is there is a problem of completeness. Like, if you don't have everything, then you might be missing a really key element of risk. Or, for instance, if, like, say, you don't have the options and those are currently hedging a lot of the risk, you might actually overstate your estimate of how much risk you have. So you kind of have to have all of it to have a good view of the risk. So we pull that all together. And then we offer a number of models. So it's a multi-model platform. You can have multiple versions of models. And we have models for different purposes. So for your kind of stock picker style or Delta One type portfolio manager, we have that factor risk model, which is a Barra-like model, if you will. Technically, it's a Fama French model. And that essentially says, okay, I'm going to break down my portfolio volatility not into assets or sectors, but into stylistic factors. Like, it acts like other things that tend to have momentum properties, or it acts like a small cap, or things like that. Very common method in traditional finance. And as you have a larger, diverse portfolio, it's another way of kind of reasoning about the types of risks that you're exposed to. So that was the first model we put out. We built a full VAR and CVAR model. So this helps you kind of characterize the downside and upside tails of your distributions, and see, are you kind of getting asymmetric payoffs from your exposure to the upside as opposed to the downside. very common way of just monitoring and setting limits on risk. And of course, to support derivatives, like a full volatility model as well. And then structured around that, we have tools for attribution. So, how to kind of break down and explain the sources of risk by those different dimensions, like asset and sector and factor. And we have stress testing, like what happens under extremes. And particularly with derivatives and ultimately more exotic nonlinear products, that's where it gets really interesting. You've got something in your Aave position auto liquidates, and it's compensated by your option on Deribit or your DeFi option vault or whatever. And this is crypto, right? It's like you don't really talk about black swans. Like a swan comes along every day. And so many risk managers, they think first and foremost about stress testing and scenario analysis. They've got a long list, and we have them built into the system of like classic crypto scenarios like the 2020 COVID crash, that they want to kind of say, all right, look, for our current portfolio positions, what if that happened again tomorrow? And importantly, where would the largest losses come from? So to get some sense of the sensitivities in the portfolio as well. And so we offer all of that today in Serenity.
Well, there's a lot of good stuff that I think we can talk about right there. And I think we have to be kind of a little bit selective, because I think we could probably be here for, multiple hours talking about this. But, one thing that you said, you listed some of these factors, style characteristics that you could model around. I guess, for someone who's always kind of been interested in this stuff, how are you optimizing your Delta One? Like, to what specific, set series of tokens? Do you have like a benchmark, or how are you looking at it?
So this has evolved over time. There is half of our team is called the research team. We actually publish papers on our website on some of the research we've done into these models, and that model has evolved. The current latest experimental version is 1.6. And one of the things that we changed over time was the original version. The market factor was based on just everything we had in the database. So we didn't have a concept of what in the practice is called an estimation universe, like a subset of it that is kind of curated. And then if you run the regression for all of your supported assets on that smaller subset. So right now we have the 131 in the database going up to 600, but our estimation universe is around 75. So we don't use today a specific benchmark index for that purpose. It is actually generated by our system. But as you would expect, like it's generally the larger market caps within that set, but we put in exclusions. So there's some interesting research that was done in the early days around factor risk in crypto, that looked at the meme coins and basically said, like, you need a whole factor just for the meme coins, like nothing else explains them. They jokingly called it the Doge factor, because like the best explanation for Doge is Doge itself.
Yeah.
So we have to take Doge out of the
Is that driven
estimation.
by like Elon Musk tweets, or what? What's the main variable that determines the debate on that?
That's right. So you actually have to take that out of that estimation universe because it'll actually skew it.
Okay. That's important to know. One thing that you mentioned there was just this, this, I think, challenge that us practitioners in the digital asset space are always encountering, which is the quality of data. When we do our, for example, when we constructed the broad cap universe, we looked very deeply into the free float supply of these tokens. And of course, people will probably think, oh, there's just thousands and thousands of tokens. But, when you actually distill it down to what an institution could actually, feasibly be trading in and out of, that universe shrinks down tremendously. And, I think we're just around 30 or so tokens. So that's just to give you an idea. So what are some of these things that you've encountered when you're trying to bridge this gap between, the TradFi and digital assets world with the data and the quality of the data, for example?
It's a great question. And unfortunately, I do have a tendency to get on my hobby horse about data problems in crypto. So I'll try to keep it brief and just highlight a couple of things. So the biggest issue is that the standards around data in traditional finance they've evolved over decades. And you just don't have that in crypto. This is an industry that cannot even agree on the symbol for the most popular token in the entire universe. And
Good
so
point.
you don't have a common symbology. You don't have a common taxonomy. You don't have the equivalent of GICs out there. And so if you are running a risk system, which at its foundation is a giant data lake merging together data from all over, from exchanges, ultimately from on-chain, et cetera, just classic data problem. You have to join those data sets together. There are no common keys in crypto. You have to create them yourself. And so the data engineering just simply to do that initial analysis is really hard. And then, as you said, like there's just the exchanges are not as mature. A lot of the aggregators are not as mature. You don't have anywhere near the history that you have, say, in equities. And so, as a result, part of the problem is it's just data quality. It's scrubbing things. It's knocking things out because they're going to throw off the model. And we've had to explain to some of our data providers, like a lot of your clients, they're just doing a chart. They don't care if things are a little bit off. We're training a model. We're deriving things from your data. So we're sort of the derivative of your data, and we're thus far more sensitive to data quality problems than some of your other clients are. And so often, like we're raising alerts internally and then going back to our data providers pretty much in real time on behalf of our clients. And that's part of the value of what we're doing. Like I can't imagine for a very small hedge fund, just being on top of that in a 24/7 market. So you really kind of need to have that cleansing layer on top, whether it's for your indices or for your risk models. If you're dealing with the raw data, it's a mess.
Yeah, I remember, when I first started researching digital assets, just having that humble moment when I realized, wow, that this isn't the data that I was used to when we're studying, traditional asset classes, and it's, on a Bloomberg terminal, and you're just downloading everything, just spitting it all out, and the history is limited. The sources vary as far as the quality, so you really have to maybe, be a little more creative and try and be a problem solver just to kind of do even some basic analysis and build narratives and stuff like that. So I fully sympathize with that. You mentioned one thing in there where you were talking about the comparison to GICs
Yeah.
and a taxonomy, and that's something that here at CFB we're trying to solve this problem. So I think using sectors and sector exposures as an example for digital assets and carrying that over from TradFi actually works super well because it's very direct. And just like you have segments, then categories and industries, what have you in the TradFi world, we have this also in the digital blockchain economy. So here at CFB, we use our digital asset classification structure, which is we call it CFDAX, and it's a very purpose centric approach to categorizing these tokens. Case in point, if you have protocols in the DeFi space that provide services like trading or lending, these are considered in the finance category. You also have, just like you have utilities, we have these settlement protocols, these categories that are providing the backbone infrastructure of storing all the data on the blockchain. So it's very similar. So I think if you look at the risk tools that you all are working with in Cloudwall, and having this taxonomy, these two things could be kind of augmented together.
Yeah.
Would you agree? It seems like a pretty straightforward fit.
Yes. And in fact, in some of our tools, we're already using sector hierarchies. Very common aspect of risk systems is decomposition and aggregation. You want to be able to drill through the risk to kind of get deeper and deeper. And one dimension that you can use for that drill through is absolutely the sector hierarchy. So it's pretty much mandatory if you're building a system like this, and kind of the lack of standards around that are definitely not helpful. So it's great to see firms, not just providing things like benchmarks, which is another key thing, for like measurement and performance, but the taxonomies as well, and that there's a lot of work going on in that space. The other thing is worth pointing out is That's helpful when you're looking at the risk, but it's also helpful as a way of reasoning about and organizing the larger universe of things that you might trade. Because you can start to ask questions like, for instance, is this particular asset vastly underperforming or outperforming its peers? Well, how do you define peers? Well, they're in the same subsector. That's one way of grouping those assets. And you can do this statistically, but having actually a designed categorization can be very useful to reason about, like, one of these things is not like the other. And I think a lot of people who come into crypto from traditional finance, they often have like just a very vague sense of like, well, this is all the same, and it's often based initially on their understanding of Bitcoin. And as they start to get into it, they realize actually there's a lot of structure to those hundreds, thousands of tokens, and they do actually naturally group. And when you look at the performance, it definitely follows. You have whole sectors and subsectors that are traveling together. And so it can help the selection process as well about what you might choose to trade, not just like understanding the risk of what you already hold.
So, Carl, yeah, you've taken us on quite the journey in terms of the evolution and the thought processes behind your development of this Serenity risk analytics suite. What I'm curious about, and I think what a lot of people will be curious about, is what do you envisage being your focus next in terms of Serenity, or maybe some other app that addresses the same problems?
So some of it has to go to the beginning of creating the company, which is I have a very strong belief that the future of asset management is not only tokenized, but specifically will involve institutional DeFi. So we're kind of in a transitional moment with all the concerns around counterparty risk and complexity that's kind of caused people to back off from that. But I do believe that's going forward. And so the fact that our product is kind of focused on CeFi instruments right now is something that I really would like to see it expand across both CeFi and DeFi and start working on models that capture those products. The other thing is our starting point, quite intentionally, was risk models and data sets that were recognizable from traditional finance. And we kind of, in the earlier discussion, alluded to this, that there's just a lot of basic problems to solve, and you kind of don't want to jump right into some novel model that people are not going to recognize before you've gotten the basics right. But I do believe that from a risk perspective, there's a lot of interesting information buried on chain that we have not incorporated in the models, that there are novel factors that can be researched and pulled out that will give you insights that are really unique to these digital assets. And then in the very long range, as I kind of alluded to in terms of tokenization of assets, I see crypto as it's just another underlier. And it's going to be an underlier that's going to be traded alongside real estate and equity and bonds, et cetera, as part of a diversified portfolio. So I'm really excited to see new tokens coming into the space, whether it's Ondo Finance or Benji, et cetera, that actually require traditional risk models like bond analytics and getting those combined in. So that's a longer term part of the vision, but we believe
Sure.
that's going to be incredibly important for asset management in the years ahead as it fully tokenizes.
Yeah, let me just press you just real quick on one aspect of that. The first part. So clearly, the whole decentralized finance piece probably is a risk analytics boffin's dream, perhaps. But what intrigues me, I mean, from a very very top level view, because that's the only level view that I'm capable of actually assessing, is in terms of DEX and maybe DAOs. What sort of additional information, additional type of system, perhaps a system that many of us have never conceived of before, do you see possibly emerging from the sort of additional endogenous risks within, say, a DEX? Any sort of like top level insights from that?
So the one that people usually start with is the smart contract risks. And I do think the whole idea of counterparty risk needs to be rethought. Like, but when your counterparty is a piece of code, the nature of the risks is different. And so there are perhaps opportunities to quantify it that today with traditional finance counterparty risk you can't do, but also it just has no precedent. And so kind of getting your heads around that is important. The second thing that I often highlight with people is a change in the nature of systemic risk, which is, I think of the model of this whole ecosystem as a giant graph. And there's connectivity between all those different parts of it. And so an issue in one part of that graph can rip through the whole ecosystem in ways that perhaps some of the fragmentation in traditional finance, the fact that things are trading on different exchanges, the things that, quite frankly, NYSE is not using the same code as the LSE. That is not necessarily true of several DEXs that are all using 1inch for routing. Or that are all delegating for like margin purposes to Aave. And so as a result, something deeper down the stack can potentially create systemic risk. And so I think in a future state, the regulators are going to have to figure out ways to reason about all of those relationships and model them. And perhaps put in circuit breakers analogous to what's in traditional finance to keep these sort of what I often say is, like, people get super excited in DeFi about money Legos, and they forget that they're all clicked together. And that means that when one money Lego goes wrong, there's lots of things attached to it that are suddenly going to go wrong. So composition is a double-edged sword. So figuring out ways to understand the consequences of that composition under stress scenarios, I think is going to be really important for the future of finance.
Sure, that's brilliant. I actually, just hearing you talk about it, I actually can't wait to see what you come up with next. So what I'd like to ask you then, Kyle, is in terms of people going on with this journey, how can they find out more?
So there's a couple of things. You can go to our website at cloudwall.tech. If you actually want to see the product, there's a get access button on there, and you can schedule a demo. We publish regular papers, not in academic journals, but on our website. So there's a research section as well. You can read papers about the models we've built so far. You can follow us on both LinkedIn and Twitter. So there's lots of options to learn more. And this is something. There's an emerging community of crypto quants. And so, in addition to people who might be interested in the product, we love to talk to people about ideas and leading edge research into risk modeling as well.
Brilliant, brilliant. Thank you very much indeed. So yes, that was Kyle Downey. He's the co-founder and CEO of Cloudwall. And we're really appreciative for him coming on to explain what Cloudwall does and what Serenity can do, and sort of with a bit of a look to the future as well. So yeah, we have pretty much come to the end of this one. I hope you've enjoyed it. I've been Ken O'Deleger. We've been joined also by Gabe Selby. Now, if you'd like to find out more about CFB, of course, cfbenchmarks.com is the place you need to go. You can also find links there to additional episodes of CFB Talks Digital Assets, as well as links for our archive of content and research, which includes a weekly newsletter, monthly market recaps, and a quarterly attribution research and data and sort of performance readings using the CF digital asset classification structure that Gabe mentioned just there. So yeah, we appreciate your presence. We look forward to seeing or hearing from you next time. We're going to be obviously in vision and also in terms of podcast land audio, so you can catch us there. We'll see you again very soon for another episode of CFB Talks Digital Assets. Thanks for joining us. Bye.